Good evening, everyone. My name is Maria Ariza. I'm CEO of Viva, la Bolsa Institucional de Valores. I don't know if you've heard of it, but we started operations 5.5 years ago, and we're doing good. But I'm very excited today to present a visionary, a great leader in the world of asset management. Marc Rowan, he's the CEO of Apollo Global Management. As of March 2023, Apollo manages approximately $600 billion under management. And under Marc's leadership, earnings have jumped from $47 to $89, adding 23 billion market cap to the company. So this really demonstrates Marc's leadership, vision, as I said, innovation, adaptability, and forward-looking. And I'm very, very pleased and I'm very honored to have this conversation with you, Marc.
It's actually my pleasure.
No, not at all. And I want to welcome you to Mexico. And we're very, very happy to have you here. And let's start this conversation. Maybe if you can share with us, what challenges have you encountered on all of the history of Apollo? And if you think we have challenges that might persist today, and if so, how's your strategy been evolving, trying to overcome those challenges?
So I'd say every business has challenges. Certainly, being here in Mexico, the Mexican market spends a lot of time talking about its own challenges, while not recognizing that they're actually in a fabulous position in the world. But as it relates to Apollo, we are, at our core, one strategy. We only follow one strategy: purchase price matters. Think of that as value. In the equity markets, people know what that means. In fixed income markets, it's top of the capital structure, senior secured, downside protected. What do you do when the market over the last 10 years, up until 2022, is just devoid of value? How do you manage a firm? That, to me, has been the challenge we've had to overcome, which is to maintain the discipline in the face of a market that's been chasing the hot dot. Because I manage a lot of type A personalities who are prone to action.
Yeah, I can believe that.
And sometimes the best thing to do is nothing. And so for me, that's been among the bigger cultural challenges to manage. But at the end of the day, firms that deviate from their core tend to lose their way. And you were nice enough to start with the statistics that we've achieved. We've gotten where we've gotten because we've been patient. It has not been a straight line up, but I feel we're in the right place at the right time, and investors understand what they're buying with Apollo, that we will do purchase price matters.
It took you 30 years to get where you are.
39, actually.
39.
There were no shortcuts.
And Apollo started actually as a private company, and you had very solid returns within private capital markets. But then you evolved, and then you have also achieved amazing returns within public markets. So how's your perspective on the relationship between public and private markets evolved, after having this need of greater exposure and liquidity that public markets offer, instead of only focusing on alternative private markets?
So I'd say the following. We have to respect the journey. So 39 years ago when I started doing this, private equity, private markets, it was a black art. No one was doing it. And so everything was new. In fact, I joined the industry in 1984, and I was 10 years too late because every good deal had already been done. And in 1990, I felt that way. And in 2001, I felt that way. So I've learned the industry is going to evolve. But let's face it, we as an industry, not just Apollo, we've gone from a niche industry to an asset class. And had the market stayed where it was, I don't think the industry would have evolved to an asset class. But we're actually at a really interesting period of time. And public markets are not what they were. Public markets are totally different today than they were when my career began. And the easiest way to understand that is a conversation that I have with leading active managers of equity. Now, that's a hard job. So for the last 20 years, active managers of equity have failed to beat the index 85% of the time. I don't think they've gotten any stupider. I think they've actually gotten smarter. But the market structure has changed. So if you're a great active manager and you identify a stock and you buy that stock and no money flows to your sector over the next 90 days, you have no return. And so you're judged every quarter. And so the active manager will look at me and say, I now understand your business. You do the same work we do. You put a little bit of leverage on these companies. And then you only have to be right every 10 years, whereas I have to be right every quarter. And I say, exactly. Now you understand private equity.
Oh my gosh.
And what I'm telling you is that the structure of markets, the consolidation of markets, the commoditization of many public markets, particularly the US market, has resulted in this in the index or not in the index mentality. If you're not in the index, it doesn't matter that you're public. No one cares, there's no money. And so private equity has been able to grow up and buy larger and larger companies in places that, from the public markets, where the public markets just have ignored, for whatever reason, their success. And it's allowed the industry to scale and still maintain very good returns.
Right. I want to maybe touch upon the fact that market asset managements are consolidating a lot. And there's a trend that not only in Mexico, we see it with Afores practically doubling their assets under management in the following 5 years and becoming even less. But also globally, I mean, this is a trend that goes in all regions. So we see larger and larger asset managers. How does this play within liquidity conversation? I mean, what does it do to the market in terms of participation, liquidity, and options?
I think they're related but unrelated. I'll start with liquidity. So in 2008, we suffered a financial crisis, and the rules by which our financial markets were governed were fundamentally rewritten and changed. We just didn't notice. None of us noticed, because right after we changed the rules in the US, we printed $8 trillion, and everything went up and to the right. Stocks went up, bonds went up, houses went up, art went up, cars went up. If it could go up, it went up. And in 2022, when we stopped printing money, we began to experience some of these changes. And one of the changes, one of the three most profound changes, is the lack of liquidity in public markets. So by some estimates, dealer capital in the world today is 10% of what it was in 2008. Dodd-Frank penalized dealer capital. Markets are 3 times their size. It's not complex math. Liquidity is 1/30 of what it was. And we've actually seen the first wholesale breakdown of liquidity in a public market. UK LDI, last fall. We read about it like it's some strange event that UK institutions were doing. It's not. It was a mistaken belief by UK institutions that they could sell AAA and AA obligations at or near the market price. They tried, and the market evaporated. They tried more, the market went down further. And so my conclusion out of this, and my conclusion or advice, things are only liquid on the way up. They're not necessarily liquid on the way down. And so that's one frame to think of in terms of liquidity. The other is the concentration question you brought up. And it's not just asset managers, it's stocks. So 60% of the US market is ETs, passive. 80% of the trading in the market is S&P 500. 10 stocks are 35% of the S&P.
Same in Mexico.
Those 10 stocks trade at a 52 PE, or they did before this week. And they're 105% of all investor returns for the last 18 months. Have we really levered our retirement systems, our savings, our wealth to 10 stocks that trade at a 52 PE? We have. And yet we sleep at night. I don't know how we do that. And it goes to, it'll interplay with public and private. We used to think private markets were risky and public markets were safe. We now know private can be risky and safe and public can be risky and safe. Mm-hmm. The risk I see, the biggest risk I see, is this concentration point that you're bringing up, and the fact that the structure of the market has resulted in all the money flowing into very few things that are bid up, and then when people need to sell them, there's no liquidity on the way down. So we should expect beta and lots of volatility.
So just...
And that, I'm very optimistic, by the way.
Oh my God. So this merging of private and public worlds that we're seeing in this concentration of asset management, I would not like to think that large asset managers are becoming competitors of let's say, exchanges. How do you see this? Is this something that you think about?
Not really. I don't think they're becoming competitors of exchanges, but I do think the structure of asset management is changing. I mean, if you look at what's happened, the 4 big providers of passive management in the US have gotten immense. And if I think about what's going to happen going forward, my belief is that passive will continue to grow. Boutiques, of which private markets I consider a boutique, even at our size, we're a boutique, we're going to grow. And I think it's going to come at the expense of active management unless active management reinvents itself, which it may. But I don't see the moving into the area of the exchange as what asset managers are going to do. But I do think the exchange, if I'm right that public and private markets are going to become closer together, I think exchanges will need to evolve to facilitate liquidity in a broader number of transactions.
Agreed. And that's something that we always think about. And we had a conversation in our dinner 3 months ago about this. And this, I mean, this is something that takes my dreams away. You know, it keeps me awake at nights. How to really develop liquidity within Mexico local markets. What do you think?
So I think it's going to happen, but I'm going to try to be optimistic for you. I want you to sleep,
Thank you.
Sleep better. So I go back in my career, and I think that when I started, there were no high yield bonds, no levered loans, no securitized product, and no ETFs. Those 4 products are incredibly dominant today. Why do we think that the products that exist today will continue to be dominant? Like, that's just naive on our part. We're going to see product evolution. And so the way at least we think about the evolution of market structure is if public markets are becoming all beta and commoditized, and private markets are where the alpha is,
right,
that's great for wealthy individuals. That's great for institutions. They can go fully private. What will the vast majority of the populace and investors buy? My belief is they're not going to buy pure private investments. My belief is they're going to buy products that don't yet exist. So imagine something that is 70% beta, 30% private markets, and it's called All Access and offers you public and private markets together. And it has liquidity and fee and other terms that don't exist today. I think that's where we're going. I will predict that in 24, a number of us will test these products in joint ventures between private asset managers and public asset managers, and eventually people will need liquidity. People will need a valuation service. People will need a facilitation of trading. And I do think that we're going to see continued evolution in the financial marketplace. That's good for you.
Wow.
This is all good.
No, really, it is. And actually, we have to talk to a regulator. No, I mean, there's a law happening at this time, and hedge funds are being allowed in our country. They were not allowed.
But it's not a Mexico phenomenon. There's this. We're coming to the end of an era. The era, it almost marks. I've had a very fortunate career, in that, in the 39 years I've been doing this, I've lived through just tailwinds. Interest rates have gone from high to low.
Right.
We've printed a ton of money. We've pulled forward demand through fiscal stimulus and borrowing, and we've had globalization. I don't think any of those 4 trends are tailwinds anymore. I think they're now headwinds or nothing. And so it will not surprise me that we need a market pivot to new products. I think on average, fixed income will be more attractive than equity. In the kind of market we're in, value will move from equity holders to fixed income holders as base rates are higher. But I think we're just in this period of evolution.
Nice moment.
So.
Interesting moments. And I wanted to just change a little bit and go back to the pension funds in Mexico. So there's some, of course, we understand that the first and most important mandate of the Afores is, to have the best returns possible for pensionees, right? But there are other views in the way of thinking that Afores should also be interested in developing and foster local markets. What do you think? What do you think about this? What should the pension funds participate or not in developing and fostering local markets, a part of course, creating best returns for the Afores?
Look, this same debate is taking place everywhere in the world. It's taking place in Australia, it's taking place in the US, it's certainly taking place here. And I guess I'd say the following: this is more of a philosophical and a political decision. Certainly, the question becomes, why should this group of investors do something or bear the cost of something that is a societal good? That's one question, but to the extent they are the largest participants in a financial market, right, and they will be the biggest beneficiaries in a financial market, of course it's in their self-interest to see a development of an orderly market in some way.
No, completely. And that's something that we need Afores also to work with us, not only in the public market, but also in the private markets, private equity, local managers, and international managers that could co-invest with us and take companies public from within from their portfolios as well. Let's go and think and pick your brains. And what challenges and opportunities you foresee in the evolving landscape of this asset allocation, given the multitude of investment options you have today, the multitude of choices? How can individual and organizations navigate this changing landscape, changing world with the assistance of financial advisors and intermediaries?
So I'd start with the following. So we did a breakfast this morning for financial advisors, particularly those who are active in private markets as well as public markets. And I started with some good news for them, because I like to start the day with good news for them. And I said to them, the role of advice is going to become more and more valuable.
Right.
That's the good news. The bad news is the structure of markets and the products are changing so fast that your job is about to get a lot harder. And really what I mean by that, we are moving from a 3-flavor ice cream world, vanilla, chocolate, and a little strawberry, to 31 flavors. And that is what's happening in markets.
That's true.
We had a 60-40 portfolio, and sometimes we added a little bit of alternative or a little bit of private market, and those were the constructs of portfolios. But everything in the publicly traded market at the moment is beta. 10 stocks are 35% of the S&P. I mean, the stats I just gave you, if people want alpha, they will need to move to private markets. Private markets does not mean private equity. It may be private credit, it may be private infrastructure, but it will be things that are not daily liquid. Or it will be products that are a blend of liquid and illiquid. The journey between where we are and where we're going is one of advice and education and trust. Institutions have been on this journey for a really long time. Wealthy families have been on this journey for a really long time. Investors, for the most part, including many professional investors, are still stuck because they're in a world where they're judged on a benchmark basis and they don't want to look all that different than their peers. But they wake up every day with this nagging feeling that 50% of their portfolio is allocated to publicly traded equities, which is fundamentally 10 stocks trading at a 52 PE. And it scares them. And they're looking for alternatives. So now the world's changed, base rates have come up. We have a number of other positive trends. and they can earn returns in credit markets in the high single digits. And you're seeing rotation out of publicly traded into private credit. Soon it'll be into private asset-backed. It'll be private investment grade. It'll be private infrastructure. It'll be a series of products and services. And so we're moving from this very simple world of 60-40 portfolio into a more nuanced portfolio to achieve the specific risk reward of a specific investor group or a specific investor segment. To me, I think it's mostly opportunity, but I will not deny that there are challenges, and the challenge is one of time frame. I've said, I believe for wealthy investors, they will be 50% allocated to alternatives in 5+ years. And I don't mean alternatives private equity. Alternatives to publicly traded stocks and bonds. An alternative to me goes from AA all the way to equity.
Right.
That journey is a journey whose speed is going to be dictated by regulatory adaptation, by market adaptation, and by education. And each of those is going through a learning experience. And it's not just a Mexican issue, it's a US issue. The biggest pool of money in the US is in 401k plans. There's some $7 trillion. We force these people who need returns the most for retirement to be daily liquid for 50 years. Why? Why do we do that? We have no idea. Because market structure, when these programs were introduced, was okay. Market structure has now changed. Regulatory and other views of this have not yet adapted. And it's going to take time. So it's an issue regulators and market participants are struggling with around the world.
You were talking about regulation, yes. Should regulators put a step in to have a more liquid market with regulation? Can you think about that, like laws including or regulation including these views or making liquidity available?
I don't know really how they do that. At the moment, the prevailing sentiment is that market making, which is trading, is an inherently negative activity, and therefore it has been restricted. And what you've seen is lots of liquidity has moved out of banks and mainstream providers into firms whose size and scale we would be staggered by. Jane Street, Susquehanna, Citadel. We think of these as hedge funds, but they're not hedge funds. They're actually market makers.
Sure.
And so what we've done is we've driven market-making activity into these private firms who are willing to accept the volatility that comes with trading because regulators have pushed trading out of the mainstream firms. Again, for that to reverse itself, for liquidity to become more widely available, there'll need to be a regulatory change in their view of trading and the public good that comes from liquidity. But I'll leave it there. We could talk about it all day.
Yeah. Marc, so you're here in Mexico. How does Mexico fit into your strategy?
So it's been really interesting. So I get, one of the benefits of my job is I get to travel around the world. And really, I've been everywhere in the past 2 years. You name a place, I've been there. And what I've said, I've met with various groups over the past few days, and I find Mexicans more negative on Mexico than anyone else.
Really?
But I start with the following point of view. The single most optimistic place in the world right now is India.
India.
Modi has made a decision about where they're going. The families are adapting to that decision. Infrastructure is being built. Digitization is being realized. They're getting the benefit from the anywhere but China, and they have a big domestic market. Second most optimistic place in the world is Saudi. Complete and total transformation, 30 million people, women out and about everywhere in Saudi society, 200,000 Saudis a year moving back, mostly educated women. And there are 30 million Saudis and only 3 million Emiratis. The scale of what's being built in Saudi is staggering. The third most optimistic place in the world? And it should be. I mean, think about the ecosystem that the three of us, the three countries have, and the purpose of this forum. In the US, we decided in the Infrastructure Act, which people have forgotten about already, and then followed by the Inflation Reduction Act, that we were going to reshore our manufacturing base, that we were going to build semiconductor fab plants, that we were going to build EV battery manufacturing plants and EV assembly plants, and we were not going to allow any immigration. What does that mean? That means we have this massive pull of manufacturing and reshoring, and it's not going to the US, it's going here. And could it be better? I think there's areas you could point to on both sides of the border where things could be better, at least from a business point of view. But it's pretty good in the scale of the world, I have to be honest.
Sure.
And so how does it fit in our strategy? I think this is a dynamic place, and the structure of this market is similar to the structure of many markets that we look at around the world, and different from the US market. In most markets we look at around the world, it's a two-sided market. And what I mean by that is there's an equity market, both a public equity market, as well as enough wealth and experience in the family groups in this country to fund interesting equity projects. And there's a banking system, and the banking system generally provides funds at low cost. What's missing is everything in between. There's nothing between equity and bank debt. That's what we want to do. And it's the same strategy that we employ in other markets around the world, including in India, where if I just, again, the market structure is not very unusual. The chance that someone like us would come here and we would see the most attractive equity transactions is nil. Nil. We may partner with local people, but we will never be the first call. The indigenous players will always be smarter, more adept. Of
course.
On the other hand, if there's no source of capital and we're bringing something to the market that does not exist, we become a pretty attractive alternative. And so the marquee transaction that we've done, not here, but in the Indian market, which is structured pretty much the same way, when the Adani Group bought the Mumbai airport, they allocated as much equity as the family felt they could allocate to buy Mumbai airport. They borrowed from the banks that which they could buy. We provided $750 million of capital between equity and the bank. All of a sudden, the phone got busy. People now understood that the amount of equity that a family group, a corporate group, or other group had could be deployed publicly and could be augmented with hybrid capital, with private capital, and with other things. That was not just a buyout. Mm-hmm. And I think that's our role in this market as well.
Mm. You have done business with Mexican companies, and you have actually invested in some of local managers. What do you think are the main drivers for you to look upon managers here in local managers for Apollo?
No, I don't know that it's different than anywhere around the world. You have all the basics, so I'm not going to repeat the basics because this audience knows the basics. But I will say that at the end of the day, what does a CEO do? And it's taken me a while to figure out this job. So our job is to create momentum. If we can create momentum in a company, we're going to win, because every business has obstacles. Companies that have momentum, the teams overcome obstacles. They go through the wall, over the wall, under the wall, around the wall to achieve. Companies that lack momentum use obstacles as an excuse not to perform. That's true. And so the diligence that we have is all the diligence you would expect, but it's also a judgment. Are they a leader capable of creating momentum? Does their team respect them? Are they articulating a sensible plan forward? Have they created a culture of decision-making, of failure, of quick response to correct failure? And it really is, it's an art form rather than a hard science of choosing great managers. But there are great managers here.
They are. I'm so honored, Marc. This has been amazing. I don't know if you have something else to finish with, because we are in time, and I don't want you to go late to anything. And we have another panel session going on. But maybe just a final thought.
Look, I think it's all changing. We've come to the end of 40 years of tailwinds. What we did to achieve returns as investors historically is not likely to work going forward. The sooner we accept that, the sooner we're going to get on to actually producing better returns. But it's difficult. We've all succeeded so well because there's been so much of this tailwind over a period of time. But it's coming to an end. I'll leave it there. Thank you.
Great. No, wait, because I need a selfie with you for my bio. No, really. Oh my God, look at this. Thank you so much.
Hi, everyone. Oh, hi. Nice to see you all. That was a fascinating conversation between Maria and Marc. And now we're going to follow on, focusing on integration in North America, and particularly the Mexican market. I'm Christine Murray. I'm the Financial Times correspondent here in Mexico, in Central America. And we have a great panel. We have Maria Ariza, the CEO of Viva, who you all just met. We have Enrique Rojas, managing partner of Mexican broker GBM, and Jordi Tacias, the managing director for Mexico at pension fund CDPQ. And we're going to talk a bit today about integrating financial markets. I'm sure in every panel you've been in, the word nearshoring has appeared, and it will appear here too. But we're really focused on the financial markets side of things. And I think to kick off, it would be great if, Enrique, you could start by just reflecting, given your experience in GBM, on the opportunity that Mexico has. We just heard from Marc that he thinks around the world, the third most optimistic place is Mexico. So the opportunity is obviously massive. And if you could put it into the context of maybe the early 90s, when NAFTA was first being signed, that would be great.
Sure, it's super hard to talk after Marc.
Not completely.
I'll give it my best. So, well, first, let me start by saying that at GBM, we're advocates of Mexico. We've been promoting investments in Mexico for almost 40 years. And so we're always a little bit biased and super optimistic. If we had this conversation at the beginning of the year, and you would ask me this question about economic perspectives, and I would have answered that we're going to grow about 3% this year, you will think that I was crazy. and today, 3% is a given. It looks more like 3.5%. And that's backed by very resilient corporations, by very strong consumer, and by the resurgence of investment. And it looks also very optimistic going forward. We have this nearshoring tailwind. We also have very good demographics. So yes, we're very optimistic. And I'm sorry, you also asked me about comparing to NAFTA.
Yeah, just putting it in the context of Mexico, the famous phrase that through the years you've heard of the Mexican moment.
Yeah.
How does this compare to other Mexican moments that you've lived and worked through?
Well, I think first, you have to compare it. First, you have to look at where we were back in the 80s. Back in the 80s, our economy, our exports were $25 billion. And about 80%, over 80% was oil-related exports. Today, our exports, it's about $600 billion, where over 90% is manufacturing. So we've become a manufacturing powerhouse. And the difference to that moment in terms of market or financial markets is back in the early 90s, when after NAFTA, we saw a lot of money flowing into the financial markets. And it was only a few years later that it started to flow into the real economy. And this time around, it's happening exactly the opposite way. I hope it happens the opposite way. We're seeing a lot of money flow into the real economy, and eventually it should flow into the financial markets. No, that's what we think. So we're very optimistic in that sense, and we're excited because we think we're in the verge of a super cycle.
Okay. And this, within the super cycle, Jordi, it would be great to get your thoughts on this. You're always looking at different sectors, different opportunities that there are within this super cycle that Enrique mentioned. Where do you see the opportunities specifically?
Well, yeah, where we're seeing, we have invested in Mexico around 6 billion now, and mainly in infrastructure. We have something in real estate, and then in private equity. So these are the main asset classes. What we see moving forward is clearly in the real estate field. We're all seeing how this nearshoring started by real estate, with industrial real estate. So we're actively looking into possibilities there. Then, no doubt, infrastructure is the other big sector that should be following, this trend. So we are one of the largest infrastructure investors worldwide. Obviously, we need to keep monitoring the situation in Mexico. Another one, and maybe in other asset classes will be more opportunistic. There's no doubt that we have these particular conditions in Mexico, as you were mentioning, like demographics, penetration of different sectors. We like healthcare, we like education. It's a little bit more opportunistic, not that related to this nearshoring wave. And there's also a big difference, I think, in the last Mexican moment and this one, which is, the forces that are pushing, right? And it's let's say it's external drivers in this occasion, supply chain related, geopolitical things that are, pushing this situation.
And people often talk about how this moment is a ventana de oportunidad, a window that opens and at some point, will inevitably close. So how, Maria, how can the Mexican market benefit from this? I mean, how can the super cycle and all these opportunities benefit the Mexican local market?
Right. So I'm going to follow Enrique's thought. I do think this will be a great opportunity for financial markets in Mexico. And we are already seeing this impact. Just to give you a sense, all of the available real estate in the northern corridor, it's flying away, like in seconds. You put something in sale and it just goes in seconds. So availability is just practically none. So manufacturing plants, signing contracts, warehousing, and of course, the fact that e-commerce in Mexico, we're one of the five largest e-commerce retailers in the world. I mean, imagine what in terms of warehousing e-commerce needs as well. So we have a lot going on, and we have felt it also in terms of financing within capital markets. So just in terms of industrial real estate, fibras or REITs, I mean, they have already gone to the market for more than $7 billion of capital, more than just in 5 months, in the last 9 months, more than $800 million of debt issuance to be ready for capex that will be needed for nearshoring. So this is only real estate, but imagine all of it that is going to spill off, to the spillover on other activities and other economies and industries all around, no? Education, housing, water. I mean, it's a lot of opportunities, and there's something else in terms of all of the companies that will be part of the supply chain of these companies, of these large companies, international companies. So those are opportunities for Mexican mid companies and small and mid-sized companies that will be able to pertain to this supply chains. And those companies in Mexico will need financing, will need access to capital to grow and to develop projects and within. So for financial markets, we're not only seeing important opportunities in the REITs already, or large corporations that are already listed in the markets that have gone out to raise more than $800 million in corporates for nearshoring, but also all of the 8,000 companies that we heard last week in Washington at the CEO Dialogue. More than 8,000 supply chain companies that will be able to form part of this. So those companies as well will be needing financing capital, and financial markets are there for them. Will be there for them, hopefully.
And I think we've outlined the opportunity and all the potential that there is in this, but there are also a lot of challenges. As Marc alluded to, we're all very good at talking about the challenges sometimes, maybe a little too much, but I think it's important to kind of explain what those are and how each different actor experiences them. It would be great, Jordi, if you could outline as a big institutional international investor in Mexico, what are some of the challenges that you think are the most relevant when you're deciding to make an investment here?
To us, given the type of capital we manage, which is pensions, I think long term is what it's our main goal, really. Then what you need is stability, and we understand that emerging markets and stability sometimes is not the same stability you can expect. But what we mean by stability, we mean that predictability in rule of law, in these kind of things that makes our investments like take market risk, not other risks that we cannot handle, right? So I would say that's the main challenge sometimes, and we understand situations, but the lack of stability is what prevents us to do more sometimes not in Mexico, but everywhere, right? Then specific, other specific to us also in this, we're very linked to sustainability for the same reason. It's not that we like to talk about climate change because everybody talks about that, but our capital needs to talk about these things. We think about 30 years, right? So we need to be in those terms, right? So also everything related to sustainability in all senses, from diversity to climate change to all of this, for us it's also central. So it needs to be a framework for that. So I think sometimes this is the sources of challenges. But again, we have invested already around $6 billion in Mexico. So it means that we can deal with, you need more. And I think that's the kind of challenges we face.
Enrique, does that chime with what you hear when you're out selling Mexico, the story to people? What do you hear in terms of what the challenges are?
I mean, I agree with everything Jordi just said. Also, a lot of the pushback or the challenges have to be with infra in order to sustain what's about to happen with nearshoring. That you hear about electricity, you hear about toll roads, about ports, but also these challenges create great opportunities. I mean, we should be focusing on making it happen. Solving these challenges. Things like, for instance, when you look at ports, Los Angeles port is saturated, and the distance between Los Angeles port and the East Coast, say Houston, for instance, is 2,200 kilometers. If you look at the distance from the Mexican Pacific ports to Houston is 1,500 kilometers. We need to make happen the investments in order to take advantage of the huge opportunity that we have in front.
And Maria, I don't know if there's anything you
No,
want to add. Yeah.
I completely agree with them. I think if we want to really capture the opportunity, we need to be ready for it, and we need to move right now. And this is infrastructure deployment and a vision of security and rule of law, and this is something that is needed, and we need to move forward if we want to attract large companies that want electricity and energy, that we resilient for their operations, we need to move forward in that sense too. We need to work on our infrastructure grid and make it available for renewable and fossils and all of the possible energy that we can deliver for those companies to have a resilient energy consumption. And of course, rule of law, and you said it, and it's so important. And also talent, shortage of talent is something that it's also needed. And we need to move forward as well. And we need to push really fast because decisions are being taken at this moment. I mean, we're only thinking on nearshoring like, oh yeah, we'll work on that. We'll put energy. We'll move on. We'll whatever. But the thing is, decisions are being taken in this moment. Yeah. So we need to have that vision in Mexico, and we need to work and walk in that path right now.
But if you think about it, also this nearshoring thing, and you mentioned Enrique, it's happening since the 80s or early 90s, right? So you mentioned numbers, and now today 600 billion the trade with the external trade, and it used to be 50 billion. So the magnitude of the growth has been and full of obstacles and momentums and non-momentums, but it's been growing since the 90s, so early 90s. So we see this trend as something that will stay. This sense of urgency we understand, obviously, because now needs to be a lot of decisions on infrastructure to capture these opportunities. But even in these circumstances, we see this happening in the next 10, 15 years, right? So it's a trend, it's a long-term trend, the way we see it.
Right, but decisions from companies will not be taken in 15 years. By 15 years, they will be here, established, and producing.
But look, someone was telling me, because we're debating the nearshoring. What's the nearshoring, right? Sometimes it's not that new people coming. They were saying, how many OMs do you expect to come, new OMs do you expect to come to Mexico? Well, we have 18 already. So maybe there's 3, 4, or 4 that are not in Mexico, right? We have a big, huge, enormous base to build on, right? So sometimes that's why we see that what happened, the Asian moment, the offshoring situation, that everything stopped in Mexico a little bit, and everybody went to build factories in Asia. That stopped. So everybody that's in here is investing in here in what they have. Right? So there's an underlying trend, very, very strong, that needs to be supported. Of course, I'm not saying that the country, but it's so strong that it's happening even in this situation.
Completely.
And in that sense, I mean, they're established here already. So the execution risk is quite low as compared to last time around, where we really had to evolve from an oil export company to a manufacturing country. Today, we're already a manufacturing powerhouse. We are the world champions of trade agreements. So the execution risk is quite low on making happen nearshoring.
That's true. And coming back to the financial sector specifically, I mean, we've all seen Mexico can attract massive investments from massive global companies that could put factories in many different countries. And obviously having a strong financial sector is important to keep that trend growing. And I'm curious, Maria, I mean, from your perspective, how do you think about the regulatory framework that there is in Mexico? Do you think it's kind of apt for this moment? I mean, what kinds of changes might you like to see on that?
Yeah. Actually, like if you asked me this question a year ago or 2 years ago, I would say we really need to move forward in regulation. I mean, we need to modernize our stock market urgently because it takes a lot of time and money and effort for many companies to enter markets, and that takes many of their interests in coming public. And then, of course, there's also the fact of taxes that are not appealing for companies for the cost of it and in the tax layer that they have to pay. So, but now things have changed, and this is because actually we are almost at this moment. Actually, the law is the new law is being discussed at the lower house. So this is going to be the most important change within capital markets for the last 20, 30 years. So this will modernize, we believe, the fact that companies in Mexico, small, medium, growth companies, will be able to enter markets in a more efficient way through simplified emission. And this basically what it states is this will be a segment that it's going to be new, and this is for those kind of companies that want to enter the market, but that will have an emission only focused on institutional investors and on qualified investors. So this will put companies in the market in a more easy way. In terms of 2-3 weeks, companies can actually become public markets and access this huge amount of money that we were talking about, that it's going to be hopefully available for them and to finance their growth. So this is really, really important. And on the other side, this part of this law also includes the fact that hedge funds will actually be ready and be available for investors to enter. So this hedge funds will have flexible mandates, and these simplified emissions could be part of their asset allocation. So I believe if we move forward and regulation really sets up this framework for this opportunity, for these SMEs that I was talking about. Just imagine the companies that are within the supply chains being really financed, and of course transparent, and of course with governance, and of course fiscal, and under the fiscal eye. I mean, this is something that will really change things. So regulation, I think, it's moving forward in a positive way. We need to, of course, work in so many other things like fiscal taxes. But I mean, this is a step forward towards a better market, I think.
And Enrique, I mean, what about the other challenges that there are for Mexican capital markets? Maybe you could talk a little bit about what other challenges you think exist, and in particular, something that we've talked about before, corporate governance in Mexico, and what are kind of the main issues that you see there, and how relevant is that?
I think corporate governance is probably the biggest challenge for Mexican public markets. When we go around pitching an investment idea to a foreign investor, the biggest pushback we get is corporate governance. It's not the economy, it's not inflation, it's not insecurity, not politics, it's corporate governance. And our research team put together a piece where we did is we graded every single company that is publicly traded in Mexico, Mexican companies. And it was 100% objective, the grades. And we put an index, market weighted, for the 10 best behaved companies. And 9 out of 10 years, they beat the IPC, or the Mexican Bolsa. So investors really take a look at corporate governance. They really care. And you see examples where, and this is true in any sector, you see examples like, for instance, in the retail sector, which is the most obvious. Walmex is probably the best behaved company in terms of governance. And but in that sector, you have 2-3 great companies that have double or triple the size, while the leveraging at the same time in the past 4 years have become global. and they trade at half the multiple, and it has to do with governance. Well, a lot has to do with governance. So I would think that that's probably one of the biggest challenges.
And what's missing so that, I mean, presumably, those companies want to trade at higher multiples. So what's missing? Why is there not the incentive to improve corporate governance?
I mean, I don't know if it's a matter of regulating it, or it's a matter of, or it's a matter of making the owners aware of this situation, because I would think that anybody would rather trade at 14, 15 times than at 6 times, no? I don't know. It's probably a little bit of both, no?
Yeah. And thinking about these issues, I wondered, Jordi, if there are any kind of practices from Canada that you know about on the regulation side, corporate governance, or any. It doesn't have to be Canada, but given CDPQ, but some of the best practices that you think maybe might be useful in the Mexican context.
No, look, I think it's all around these concepts. I mean, governance. I think it's the same thing. Process around governance in Canada has been the same. It happened already, so now, investors are super demanding on that, and it's a little bit more spread, the good practices in governance, for example. But I don't think it's different one country to another. It's a matter of where we stand in terms of these 2 or 3 things. For example, if there would be, we all know that tax-wise, it's expensive for owners today to go public. Maybe with a window of opening that part could help. But what's clear is that it's needed.
We should send this part to the regulator.
Regulate. But also you were mentioning, Maria, said, now you start the process to go public, and it takes you 8 months because it's a long.
To be better now.
Yeah, it's a long process, and then all these. So that's why I'm saying it's not different from other jurisdictions. You need to go through these. And you were mentioning also, because it's interesting because companies in Mexico normally have been super well capitalized. So the real need to go out there and raise capital, it's not been that obvious, right, all the time. So most of a lot of IPOs are just driven because it's a good moment. It's price is there. But is there really a view that the market will be my partner moving forward, or is it just a window that I take to go public, right? So, and this goes with governance again.
And also, in terms of not only capital, but in terms of secondaries, you were talking about taxes. We need to fix that as a market. Instead of having incentives to the long-term investor, the one who took the risk, who is the owner, we make him pay way more taxes than and I'm not saying that these original owners should pay 10% like the minorities, but we need to come up with a scheme like in every other market where you benefit the long-term investor. If you look at the last 5 years, offerings in Mexico, 90% of the money raised it's been fibras. Only 10% it's regular companies, and the reason for the fibras being all over the place in the market, it's because of taxes. They have great advantages. We need to incentivize something like that to companies.
And how do you think about retail investing in Mexico, which is obviously growing, and how do you reconcile that with the liquidity risk, that the liquidity not being deep enough for some institutional investors in Mexico? How do you think about those two trends happening at the same time?
Well, I think that, and Maria and I, we discuss a lot what's the problem, demand or supply, and I think that the problem is really supply or size of the market more than the retail accounts that finally it starts like it's coming alive as a market. We were at 200,000 accounts some couple years ago, and today we're close to 7 million accounts as a market. But more than that, there is demand. There's institutional demand, both local and foreigner. If you look at the Afores, they're worth $300 billion, and they're going to be worth $600 billion by the end of the decade. They only have 7%, 6 or 7% in the local equity markets. When you look at any other public pension fund from any other country, they go anywhere between 25 to 50%. So on their ownership, it's amazing. And then again, it's a matter of size. Our market weights, I think it's 0.2 or 0.3% of the indexes in the world. Mm-hmm. Our economy weights 1.5% of the GDP of the world. So if we would have a bigger market, we would be in people's radars. You know, the institutional investors would need to have money allocated to us.
Agreed. Can I just jump a little? No, I agree with him. Of course, we need more companies and we need more vehicles available for investors, but also we do need more assertive and participation of pension funds in our local markets. You cannot have the most important institutional investors in the country having less than 5% of allocation in equities. And that takes you to a smaller, even smaller market every time. That gives you the listings, that gives you even less attractive scenario for them. So we need a base. And it's not a fact that we don't have the capital available. We do. It's a huge. I think we need to put it to work and attract companies. And I know for a fact that there are companies in Mexico that might come to market if the valuation is there for them, if there's appetite from investors for them, and you know, there's an opportunity for them to grow. If the valuation, when they go and you know, tap the doors for an IPO roadshow, doesn't make sense for them, then they will not just, you know, put a shoot on the foot. I mean, it's not going to happen. So we need a base, an important base of institutional investor capital to have a base, an interesting size, and then I think companies will start flowing. And we have startups, Enrique, and we have companies that have gone abroad and have done IPOs abroad for this reason. It's not because there are not companies, it's because there is not interest here, or there's not enough liquidity, or there's not tax incentives, or so on and so forth. So if we are competitive and we put money to work to our markets, and we keep on going with your strategy, which is amazing, on retail and technology and promotion and everything what we're doing, and then we move on regulation, that's something that we're pushing. I think things could be different.
It happened in other markets. We've seen in the region other markets that developed their markets, you know, quickly, and it was a number of reasons. But I think I tend to think again that there's not enough assets to look at today.
Yeah. Which markets would you say are examples to look at?
To me, no. To look at from the private equity perspective, for example, we're really struggling to have a more aggressive strategy because we don't have exits. We don't have a market. And
would you like a local market for exits? Yes. I'm trying to work on that.
It's okay. That's what we need, because then it's critical, you know, for
totally.
a private equity strategy. And then, but you see other markets that.
And your assets can be part of the market, and those assets will, you know, attract capital, and not only institutional local capital, that will attract, as Enrique said, international capital into the world, into the market, Mexican market.
Mark mentioned India.
That's right.
In India, which it's a great example of something that they're doing right. The international companies based in India, there's 40, like Walmix, it's a non-Mexican company, and it trades in the Mexican stock exchange. There's 40 of Walmixes in India. If we could have the OMS, if we could have Ford Motor Company of Mexico be listed in Mexico, if we could have, I mean, if we would create some incentives for them to be listed here, probably they could trade at a better multiple than they do in the US, because if it's focused to Mexico and to the nearshoring theme, you could probably get, there's a lot of companies.
And we're running out of time, but I think we could keep talking, but it would be great if each of you could kind of give a final thought, bringing together some of these ideas and thinking about Mexico adapting to what's happening, the trends that are happening all over the world. I mean, we've already mentioned ESG, and there's the whole fintech sector we haven't even touched on, and this question of, you know, whether the local pension funds should be supporting the local market or if they should be getting the highest returns wherever they can. It would be great to just put what's happening in Mexico now into a global context. If each of you, Maria, I don't know if you.
Well, I think I said it. I'm very optimistic. I think Mexico is in a super special time, and I know about this Mexico times in other moments, but I do think this is very, very important, and if we are ready to capitalize it within capital markets, creating a local competitive market that can really encourage investors to come in, to participate in our assets. Our all assets will come in to our markets, and that will bring everything available for investors, and valuations will go up. So it's a chicken and egg. I think we are moving in regulation. We are moving in, of course, in attraction of new capital, and with technology that we were doing in Viva. We think those three aspects will have an impact, and I'm positive of that.
Enrique?
I think that, I mean, we're super positive also on what's about to happen. If you look at the last 4 decades, from 85 to 93, the Mexican bolsa yield 2,800%. Then we had a lost decade. Then from 2003 to 2013, it yielded 800%. Then another lost decade. And I think, again, going back to the super cycle, we're on the verge of super cycle. Valuations are there, and we have all the tailwinds. Now, there are 4 participants in the market. It's regulators, investors, companies, and regulators, investors, companies, and investment banks or intermediaries. We need to build a scheme where everybody wins, because that's the only way how we're going to be able to take advantage of what's going on. There's things that need to be done from each of those 4 participants.
That's true. Jordi?
Yeah, I think the trends are very strong, and these are real and happening. So for the long term, we like it or not, we will have a big financial market, we'll have a better manufacturing base, we'll have good results. Yeah. Because it's even, it's like a trend based on a lot of external things that are happening are real and very, very, very strong. Yeah. So we're, in this sense, for the long term, very optimistic in all senses.
Well, thank you so much to all the panelists and for all of you for joining us. I hope we can continue the conversation after the end of the panel, because that's part of what this is all about. So thank you very much.
Thank you so much.
Thank you.